Our next guest says great first halves often beget more in the second half, especially in presidential election years, but this time may be different. Morgan Stanley Wealth Management CIO Lisa Shalett joins us. Lisa, great to see you.
Good to see you guys.
You sound pretty defensive when it comes to the market's path into the second half of the year, highlighting a lot of risks, geopolitical, fiscal, et cetera. I mean, the list goes on and on.
Well, actually, we're not all that defensive. I mean,
okay.
our piece was really about what is defense in this market. And so our concerns are about the lack of breadth, the concentration in the market cap weighted index, and the Mag 7. If we're in a soft landing, this should be a market that's broadening out. We think that we are in a soft landing. And I don't think what investors are really paying attention to quite yet is the fact that Mag 7 earnings for the remainder of the year are going to massively decelerate from growth rates this year, quarter over quarter, of about 27, 28% year over year profit growth to something closer to their normalized range of somewhere between 12 and 15%. At the same time, if we're to believe bottoms up analyst estimates, the rest of the 493 are actually going to see their profit growth accelerate from year-over-year comparisons that are virtually flat this quarter to something that exits the year well over 10%. So we want to be owning the stocks where earnings growth is accelerating. And so what we're saying is, look, everyone wants to crowd into the same old names. That's where the risk is. That's not defense to own the Mag 7 at this point. Defense is to own breadth, to own the equal weighted, to be an active stock picker, to own things like financials, like energy, like industrials, like healthcare, like utilities, like REITs, all these things that have been lagging the market and yet are much more apt to put up earnings surprises and earnings acceleration in the second half than the same old names that have led us here for the last 2.5 years.
You're not saying, though, Lisa, to get out of the Mag 7, right? It's just to allocate some money elsewhere. I would imagine it's a hard sell for you to say to investors, pull some money out of NVIDIA and put it in healthcare, which has not done very well this year so far and could be under political pressures itself.
No, absolutely. Look, we're not saying, that any of those names are not, decent companies and shouldn't be in your portfolio. We just don't want to chase them at these levels. And as I said, I think that as people see their earnings growth normalize, right, they've grown into their recovery trend. One of the reasons that the year-over-year profit numbers over the last 18 months have been so great is people need to remember tech earnings collapsed in 2022, right? And so we're going to lap all of that. We're going to have much tougher comparisons, and that year-over-year earnings growth advantage that the Mag 7 had, where they were growing at over 30% and the rest of the market was not growing, that's going to shrink. And you're going to have a lot more companies putting up very decent year-over-year earnings growth, whereas, the Mag 7 are going to start to normalize into that, 12 to 15% year-over-year range.
Lisa, is there a way to handicap what might turn investors' focus in that direction? Because it seems as if the unusual nature of this cycle maybe is keeping folks from really emphasizing those types of ideas, because it would seem like that's an early cycle thing, right? Where you basically say, oh, we have an earnings recovery story. You can buy riskier, financially, lower quality stock, whatever it might be, more cyclical stocks, and that makes sense. Maybe it's when the Fed cuts and you've averted the down part of the cycle, but I just wonder how you're thinking about that.
Yeah, no, great question. So I think that there are a couple of things to catalyze it. To your point, I do think that first is rate cuts. But the second really has to do with, us starting to put some reality around the mythology that is generative AI, right? It's great, for these companies to be telling stories about all the great CapEx that they're putting in the ground, all the capacity that they're building in data centers, for all the software and services that they're going to sell to all the adopters of AI. But we've got to see that next chapter of monetization happen. And that's where I think that we've got some skepticism. There's no doubt that generative AI is an enterprise-wide transformational technology like the internet was. But like the internet was, it is going to take many years for us to actually understand who the true winners and losers are here. And we think that a lot of this enthusiasm has gotten over its skis. And not all this CapEx is actually going to have very high ROE attached to it in the near term.
Lisa, great to speak with you. Thanks.
It's always great to see you guys. Thank you.